Gold. Let's talk about gold getting hit today, closing out its first weekly loss in 2 months. But the chartmaster says to just keep buying bullion. Carter, head over to the plasma. Show us what you're looking at.
This is something you should be long if you want to sort of diversify your portfolio instead of just being long equities and hoping for more drugs from the dealer. Gold.
Wow.
Here's the chart. No annotations or drawings by me. Here, one way to draw the lines. Well-defined tops at a common level. A well-defined breakout, and then we've pivoted back, right? We've dropped from this week's high of 1441 to about 1400. That's what's called a reaction buy point. Nice entry point if you're not involved, and if you are not big enough, it would be the time to get bigger. Pull it back. Another way to draw the lines. Pull it back a little more. Another way to draw the lines. But basically, this has all the elements of a major rounding bottom. You can get rid of that, and you could call it a head and shoulders bottom. But it all points to one thing, a big period of equilibrium that looks to be resolved, and the sell-off this week, I think, is quite an opportunity. Let's zero in a little tighter and talk about what's going on, a little bit of the conversation we just had on the desk. This is gold and the TLT. And, of course, bonds sold off, gold sold off. But basically, what you'll see here is that this is a normal reaction, meaning after a big move, you rest. After a big move, you rest. After a big move, and we're doing the same thing ultimately in TLT, and I think you've got this same setup. We'll just draw the little staggered thing again. You get a big move, you pull back, a big move, and this consolidation ultimately, and that's the bet here, is resolved up and out. I want to be long gold, and if you're already long, I would get bigger.
Is this a safety trade you'd buy into, Mark?
Yeah, I think this is going to continue to work, at least for the next few weeks, few months. Like I said, until we hear that positive tone shift, if we actually hear that from CEOs. Where would we be putting money right now? I don't know that gold makes sense for us at this point for our clients. I really look at this as more of a calamity hedge. Use it as an inflation hedge, and there's really no inflation right now. In fact, we're fighting deflationary forces because tariffs are really going to weigh down prices.
See, I understand why gold is rallying, and certainly we talk about the negative yielding assets around the world, the European bond curves, et cetera, et cetera. So this is a place where gold actually giving you nothing in terms of yield is actually positive. Carter, about a month ago, I think it was probably a Friday show where our final trades, he was actually long gold and I was short it. He was right, because at 1350 for the last 5 years, we've been running up against this level, and this is the time that at least we've broken out to some point. And the question I have is really, if we get less Fed rather than more Fed, what happens to gold prices? Chasing gold to me, and obviously I think we're all talking about this in the context of a rational portfolio allocation. Mm-hmm. Sure. So whatever that is, 1%, 2%, 3%. But chasing it here, I don't feel good about. And chasing the GDX, I think is very, very dangerous here. Gold miners are not gold.
Embedded in that sort of statement about the Fed is what happens with the dollar. So do you see dollar weakness?
Right, and the dollar's slumped and the dollar's recovered a bit. But I mean, it gets back to like what does, if they cut 25, I don't really know whether gold likes that or doesn't like that. Ultimately, if they start really cutting. And
they cut 50, gold likes it.
Gold likes it,
yeah.
Sure.
Paul Tudor Jones pitched it June 12th. He said that it was his best idea for the next year or two. This, gold rallied about 3%. And then when we saw on the 19th the Fed come out, it rallied another 6%. So I do think, to your point, if you get less Fed, you get less gold rally.